Testing, testing, 1, 2, 3. Testing, 1, 2, 3. Can anybody hear me? Anybody hear me? Nope. Sounds clear? All right. Oh, Risen. Hi. Hi, Vicky. Good evening, everyone. Good evening, everyone. It's been a late night. Thanks for joining. Thanks for joining. Yeah, welcome back. Welcome back. Yeah, it's our bi-weekly Ocean Playbook series. So that we are going to start it at 8 o'clock. So that we wait for the rest to actually join the section so that we can get started after. Okay. How's everyone recently? Like yeah, market greens for the last week. I'm not sure whether you guys did make some profit from like long call and maybe like cover call and or maybe capture some premium from it. Yeah. How's the week? Like, hi everyone. Hi. Thanks for joining. Thanks for joining. Oh, hi. Hi, Linda. Hi. Anyway, how's the week? I like, has any one of you like make some profit like for this week, maybe last week? Yeah. So as usual. Oh, hi, Nyonya. Hi, 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 hi. Good to see you. Yeah. Recently you've been late. In the middle of the session, you only joined. Like, I guess you've been busy with your work or something. You know. So as usual, like Option Hunter will be help me addressing those kind of questions whenever you guys are asking because like I'll be only focusing on presenting some slides. So whenever you guys have any kind of questions, you can just like ask in the comment section so that the Option Playbook will be try his best to actually address it. You know. Very busy, by the way, I'm collecting some. Yeah, yeah, yeah. The playbook is I think it's I think it's coming soon already. I think you guys be able to collecting the books as soon as possible. And yeah, hope you guys love it. Yeah, hope you guys really love it. Because the book basically is like cover a lot of things up. Like lots of confusions as well. Like clear off those kind of confusions that options traders might be facing. So that it's basically like a step-by-step guide. Like by using the apps, how to actually like applying with your knowledge on into something that practical. It's a very good book. I would say it's a very good. Zoom is collecting tomorrow. Oh, thank you, thank you. So fast, you guys can get it. Didn't expect it so fast. Yeah, the early birds, right? The early birds. This is a very quick question, so because we have been like conducting a few sessions already, so then I'm not sure whether you guys have traded your first option trading or not. Have you guys started your option trading? So I mean, it's like I know you guys been like trading with the stock and then like different kind of a region of the stock. No, I can't see the screen. Has it started? Yeah, it's started already. I think it's like it's a holding slide now. Yeah, I'm holding the slide because we'll be starting it at 8 o'clock. We are waiting for others people to actually join because it's only like 7:57. There's a couple of options here and there, not many. Just started going slow. Yes, yes, yes. You have to take your own pace. I see someone 我嚟撐場 哦，唔該晒，唔該晒。估唔到有廣東人入嚟啊，係香港人嘅。Who have so it's true actually it's like you should be going slow instead of like trading at a very high like number of times large number of times because like you still have to follow your thesis then you have to take your pace to actually see which strategies might be like suit with your thesis, like not every like strategy suit every kind of no there's no one options trading strategies that can suit every single thesis. Yes. Yeah, you can try refresh the whole like refresh your browser. Not sure whether like because like from my side I can see my, my holding slide there. Not sure whether is there any technical issues that you'll be facing there. So we're going to start at 8. Okay, it's 59 now. Yeah. If you only lower down your options, I would say our face is quite competitive actually. Yeah. Yeah. 7:59. So yeah, I see a lot of mini like coming in already starting to. Yeah. We're gonna start at 8 o'clock. So yeah. So we are going to it's 8 o'clock. So we are going to start these sections. So so in today's sections, like before we go start, as usual, like before we start these sections, we are going to have some disclaimers, right? Basically, it's like all the it's telling you like all the education, all the sections that I mentioned, all the ticker symbol and the features that I mentioned, or maybe presenting to you guys is purely for education purpose only. So please be aware, and then also that understanding the risk of the options, and then all some of things is hypothetical. So that please do not take it as a financial advice. Okay, so yeah, so we are going to start now. So let's do some recap. Okay, recap. So the last week, sorry, last 2 weeks we did cover one of the sections, right? Basically, it's like you guys have learned the cover calls, right? So cover call basically is like 100 shares with a sell call. And then so that this is the first spread that you guys have learned. So to actually like holding your shares while also collecting some incomes, right, by selling a call until it hit your target price, then you sell your shares. But if let's say it doesn't hit your target, then you get to keep your income. So that's basically what we have covers lah. So it's like a comparison because traditional investors that we buy the stock and then we just like buy in hopes, right? If there's a stock went sideways or maybe go down trends. Basically our money is like a dead money, you just like keeping the assets like without generating any income. So that we introduce the cover calls to actually allows you to collect some premium while you're holding the stock. So like if let's say the stock keep going up, going sideways, but it doesn't hit your target price, you just keep collecting your premiums. So that's how it is. So not sure, just a quick question is like, do you guys actually like um uh study? I mean like study about this cover call? Have you guys fully understand how cover call works? Like type one if you really do understand how it works already, or you guys still need some time to digest. Then type two, you know, one. Yeah, yeah. This is oh, okay. So like we since I see a lot of people's like type response already, so that I guess like you guys actually understand like the how the cover call works. So in today's sections, we are going to cover the second income chapter, which is the cash secure put. Basically, it's like telling you guys like how to get paid to buy. Okay, so as usual, we are going in some comic. So this is you. Basically, this is you because we are seller this time. We are taking the $500 premium and we are betting on what? We are betting is that this fella who buy the insurance, who buying the insurance that ensures the car won't crash. Yeah, he's buying the insurance that making sure that if his car crashes, we are going to pay him. Okay, we are going to buy this asset so that what he need to do, he need to pay the premium. So basically, we are going to collect the premium from the buyers. So that we are betting on what, as long as this fella, he drives safe, the car doesn't crash, after a certain period of time, like within the terms, after the terms and conditions, like for example, like maybe 30 days of expirations, then the policy expired, then we just keep the $500 premium that he paid. But if let's say during the time within the 30 days of the times, or maybe like 20 days that they already been discussed, have already during this period, this fella really does crash his car, so that we have to like buy the cars from him, and then we have to just pay the cars with 50,000. Okay, but the premium is still yours. Okay, but so this is a disaster, right? Because whenever we selling a put, so without any cash and all those kind of things, it's a kind of disaster. But like in the professionals ways, or maybe like some of the traders, right? They actually love this kind of strategy, you know. So how does it actually work? Last time we actually is like says that the first spread is the one stock with one sell call, right? But in today's section, so I'm going to teach you guys the second spread, which is your cash with a sell put. Okay, your cash with a sell put. Basically, what it means by that. Okay, you already have a cash that you want to buy the stock. Say, for example, if let's say the stock is at $100, okay, you already have the cash to prepare to buy, but you don't want to buy it at the spot like $100. You want to buy it like $95. So what you do is like you add on another sell put at $95. Okay, so what it does, like the buyers of the put will pay you the premium. Remember the chapter 2 that we covers like the relationship between the buyer and the seller. The buyer pay the premium, the seller receives the premium. So the buyer pays the upfront premium to you. So you sell the put option to the buyer. So what you actually promise is that you promise to actually buy the 100 shares at the strike price. Okay, if it says, for example, just now I mentioned like $95, right? If I'm selling one put options that strike price at $95, so if the stock goes down below $95, I obligated to buy 100 shares at these prices. Okay, and I already have the cash for it. Okay, so this is the second spread. So cash is also one of the asset, you know. So what happens is like if let's say the stock never drops to your discount level, like $95, it never drops below that level. So you get to keep your premium and you repeat. You keep on repeat. You keep on repeat and repeat and repeat until it hit your ideal price. Okay. But if let's say it drops below the strike price, which is the $95 that we mentioned, then you get to buy the $100 95 buy the shares at $95 and also keeping the premium. Okay, so it's kind of like a different kind of things from the previous sections, right? Previous sections is what we already have we have the stock, we add another sell call so that we need to sell our stock away. But in this time, we do it in the inverse way. We want to buy the stock. We want to buy the stock. So we do cash together with sell put. Okay. So understand, huh? Okay. Can you guys catch up? Like, because like I won't be mentioning against like those kind of basics lah, because I will be just sticking with these strategies. Like there will be only two outcomes at the expiration. Either the price stay above the strike price, you get to keep the premiums, and then you get to keep your cash also. If let's say it drops below the strike price, then you have to buy the hard shares at the strike price, and also keeping the premium. Okay, so let's move on. So this is ideal for what? Like for some accumulator, because like have you guys heard about that DCA, like dollar cost averaging? Can you type one if let's say you guys have heard about it, like keep on buying stocks like every month? Okay. Can you guys type one if let's say you guys know what is dollar cost averaging? Okay, so basically cost averaging, right? Every month you actually buy take a portion of your money out of your salary or maybe out of your some income or other things, right? Then you just buy the stock regardless what price, right? But there will be, in fact, there will be two types of the DCA investor. One is like the active one, another one is the passive one. So the passive one, basically they don't care. They don't care what is the spot price. They will just buy it like that. If it's $100, they will just buy it $100. If it's $110, they will just buy it $110. But the second types is like the active DCA. Basically, what it means by that, like whenever it's like the stock price is at $100, they won't actually just buy it straight away. They will just buy at a discount, maybe like $95, maybe like $90. And then the next time they will look at some of the analysis as well. They will just place the order at the ideal price that they want to collect at. So there's a difference between like the active DCA and the passive DCA. So the problem is what? Sometimes, like if let's say you just buy the spot, right? When you conduct your analysis already, sometimes like you buy regardless of valuation. Sometimes the valuation is already very high, and you knew it, and you already knew it, but you still buy it anyway. Okay, so sometimes you might buy it at the peak of the market. Okay, and then the worst part is that your cash basically is like what if let's say you are doing some active DCA, you're basically placing a limit order at the price lower than the spot price, right? Like $100, I place a limit order at $95. Sometimes it doesn't fill your order. It basically doesn't fill your order, and then you just go like it just went up without you, and then or maybe you just went sideways for a very long period of time. So it's kind of frustrating because like when you're just placing an order then there's nothing, and your cash is like not been placing into some asset or maybe some income products. So what you need to do is now, okay, so here's the waiting games right now. So you did your homework, okay. The stock is trading at $100, but you only want to buy it at discount, buy it at a discount of like $95, and then you have two choices for your $9,500 Okay, you have two choices. One, you lock up, you place a limit order here. You place a limit order here. Okay, and then you wait. So if the stock price hit your level, it can be your support level, it can be your valuation level, okay, you only get the stock, right? Okay, you only get the stock, but you get not things, right? If let's say if it went sideways and then it goes up further, you get not things, right? But what if you sell a put, which means that we are shorting a put? Basically, we already know that where we want to buy at. So why don't we actually just sell a put, and then we have our obligation to buy at $95 since we already want to buy at $95. So we just sell a put at $95, and then we just get paid by placing this order. Okay, we just get paid by placing this order. So what happened is, if the stock price doesn't go below the $95 strike price, you get to collect $150. So you enter another sell put, you keep on getting paid. Okay, even though the stock doesn't hit your limit prices. So this is how the like how the cash cycle put can solve a lot of issues, like the yield issues and the time issue and the opportunity cost issue. Okay, so that's why I mentioned, like if let's say the stock price, like from $100, it went up to $110. If you just only placing the limit order, the order never got filled, because you are placing at what? You're placing at $95, right? Okay, you're placing at $95, so that it never filled because it never reached until 95 to $95, right? But you are shorting a put, you get paid because the option expired, and then you just receive the premium just like that. Okay, just like that. But if let's say the stock went sideways, it stay flat, like maybe like at $100, 101, 102, or maybe 97, something like that. It would just went sideways, but it just doesn't hit your limit prices. So you get nothing as well. It's a dead money. You earn nothings for the month. You earn nothings. But in short put, you still get paid because the option expired, because it just doesn't hit your $95 strike price. So you still get paid. But if let's say the stock price does goes down, okay, it does goes down. For limit order scenario, you're happy because like you just bought it at $95. But in selling a put, you also get to buy the shares at $95, but also get paid with the premium. Can you guys see the difference? Like the limit orders versus the selling of put. If you already plan to buy 100 shares at that level, why you need to like just place a limit order? You can just get paid by shorting a put. If you already plan to buy at that level, you have a very strong convictions, you just want to buy at $95. Can you guys see the difference? If let's say you guys understand what I'm saying, just type 1. Okay, I want you guys to actually understand this. It's very different from cover calls, right? One is like you want to sell a share. This one is I want to buy the shares at a discount. Yeah. Okay. Right. I see a lot of one. Okay. So who should actually consider this strategy? Okay. Basically, this strategy is designed specifically for income seeker. Okay. So the first thing first, the capital requirement is like kind of like moderate to high, because you need to buy 100 shares, right? So if let's say the share price is very, very expensive, like maybe like Facebook, like Meta, those kind of shares, right? Buying 100 shares is kind of, your capital is kind of intense, But if let's say you're buying like $100, those kind of shares, right? It can be like kind of moderate, so that because you remember the spread is what? Sell put plus what? Can anyone answer me? Sell put plus what? For cash secure put. Can anyone answer me? Sell put plus cash. Yes, cash. You need to have enough cash in your account, okay? So that you are prepared, you are comfortably to buy the 100 share at your target, which is the strike price that you have chosen, okay? And then the risk profile is kind of like moderate, okay? Because like you already did your analysis, like it can be a very solid support. It can be a very solid undervalued prices that you're willing to actually buy at. So but you have you did your analysis already. You have the convictions like the $95 is your best price. You just buy it, but it doesn't it doesn't change that the stock price can continue to crash, right? Like $95 to maybe like 94, 80, 70. Yeah, the stock price still can goes down. It all depends on your analysis as well. So that let's say it's only it's only suitable for those who understand what they are doing, and then they are believing the buying this collecting the stock at the for the long run, or maybe they just want to keep the stock forever at that prices, okay, for that particular months. Okay, and then the objective is what your this strategy is suitable for those who want to buy the stock at a discount, like the active DCA, or maybe you did some analysis on the stock. You think that the fundamental is very good. You think that now it's currently undervalued. You want to buy a further discount. Then you're willing to actually use that money to buy and hold it for long term. Then you just use this strategy, and then you don't want to like lock up too much your cash by just placing an order. Just sell put. Okay, the horizon can be short to medium terms. Okay, can be short to medium terms. Okay, but recently I did some learn some things like from one of our colleague, and it's been amazing. You can actually do a long term cash secure put. Actually, you can do a very good long term, and then the return is quite good actually. So yeah. So when do you actually like use this strategy? Okay, when do you actually use it? Basically, when you are waiting for a dip, you can just selling a put. Okay, when you are waiting, for example, it's like maybe the price is going to just keep creating a high and a higher low and a higher high, and then you're waiting a dip to buy at the support. Okay, then you choose that prices. Basically, you think that it will hit the support, then it will just go up. This is one of the way. Another way is like maybe some of the news has been hit the stock, and then it hit the stock tremendously, but the fundamental doesn't change. So that maybe you are waiting for a dip, and then you think the dips maybe is like, say for example, it's like for $100 it already crashed to 80. You think the dips is like 70, then you can sell a put at 70. You are waiting for a dip, then you only do a sell put. Okay. Or you think that it will be a very choppy market. It just doesn't goes to your. You think that it won't hit your strike price. Okay, but even though it hits your strike price, you are happily buy it at the low side. You are happily buy at the low side, not at the high side. So that if let's say it continue to went sideways, you just keep collecting premium. Okay. And also, when the IV is very high, and then you remember the extrinsic value, that I have taught you guys. When the implied volatility goes up, your premium tends to goes up. So when your premium goes up, it's also one of the ideal way to actually shorting the put, because like you get to collect your premium at the very high prices. Like in the normal market circumstances, maybe like you are collecting like $2, so that is a $200 pocket money. But when the IV is high, maybe you can get like 350, like 400, or even 500, because like the IV elevated already. So that is a very, very good time to actually sell put as well. Okay. So because, and then one of the pro tips is that when the market goes down, right, the IV tends to goes up one. So when the IV goes up, right, you basically like able to collect more premium. If let's say you guys already know that which level that you want to buy at. Okay. So, and then another two things is that you need to avoid the trash stock. Okay, for example, basically is that you did the research already. You think that it won't goes up, but if you just want to collect for the sake of the premium, I think you need to avoid that lah, because like you do a cash secure put because you believe that the stock will goes up eventually, and you want to buy it at a discount. That's the whole idea of the cash secure put. It's not like I want to collect the premium so that I sell a put on a trash company, so that I collected the premium already, then I'll just like eventually, if let's say it's hit my strike price, I'll just buy a trash stock. But eventually the trash stock can cause like capital losses. more harms than your favor, you know. So another thing is that avoid like exploding upward, because like if you already know that timing, that particular timing is already it will just go up immediately. Okay, it will be breaking out soon. Sometimes you just might as well you just buy the stock, or maybe you just long or call, because like the risk and reward versus your cash secure put, it not comparable. You know, it's not comparable. You know, if let's say you guys just know that it will just immediately goes up, so you can just like buy the stock, or maybe just long a call, or maybe do other long spread, you know. Because like selling a put doesn't make any sense, because like you're just collecting the maximum profit, you're just collecting the premium. Okay, if let's say you think that it will just immediately goes up, you just buy the stock. If let's say it is going to take time in a very slow pace, then you only like do a cash secure put. No, okay. Why this strategy work? Basically, one of the things is like option have expiration, so that as the times goes by, your option premium getting lower probability to travel to in the money. Okay, above your strike price or below your strike price, so that as the time pass by, if let's say that it doesn't hit your strike price, basically your extrinsic value will be just like the ice melt. You know, like eventually it will just expire worthless. And then another things like is you monetizing your patient, because like sometimes we just place and standard orders, you generating zero, like you're waiting for weeks or maybe for months, you're placing an order there and then just waiting for nothing. Okay. And then but selling a put basically like paying you, because like some limit order, it can take like days or weeks, you know, but it doesn't, it just doesn't pay you. So if let's say you are in that kind of a cases, you can actually sell a put, and then you're just collecting the premium by placing a limit order. You know, you can just do that. And then also like discount buffer, because like if you sell, if your stock is like $100 now, and you sell a put at $90, and then you're also collecting at $3, basically your true cost is at 87, you know, because you collected this at $3 premium, and then your strike price is 90. You pay for 90, but you also get paid in $3, you know, so that your actual cost is actually like 87, so that it lower down your average cost price as well. Okay, so that's how it works lah. So how to trade this strategy? Okay, so the first things is like you need to have a cash. Okay, you need to have a cash. This is the first rule. If let's say it's $100 shares, then you need to have what? You need to have the money to buy 100 shares, which is like 10K. You need to have that cash in your account. Okay, and then the second thing is that you need to choose your expirations. Okay, it's just same as the cover call. If let's say you are selling a put like within like 7 to 14 days, you get to choose your strike price in a much more flexible ways. So what I mean by that, like if let's say 7 days, I'm collecting at $100, okay, or $100, okay, and then if let's say the price eventually like from $100 goes down to $95, maybe after 7 days it doesn't hit your $90 strike price. Maybe during the times when the price at $95, you want to adjust the strike price to a lower strike price, like $85 strike price. You can adjust that after 7 days. So it gives you a lot of flexibilities, you know, like you guys get what it means, right? Because like $100, you sell a put at 95. If let's say the stock price goes to 97, after 7 days it doesn't hit your strike price, right? So it expires, you collect the 100, you collect the premiums already. So when the times the stock price at $97, maybe you want to get a much more lower prices. You get greedy already. So like maybe you sell a put at $90, so that after 7 days you're collecting another premium. If it doesn't hit the $90, you can keep on adjusting at a much more flexible way. But the cons is what? The cons is your premium tends to be lower. Yeah, no, the shorter period of the expiration, your premium tends to be lower. and then it require you to have a active management, I would say, you know. But if let's say you are doing you don't have the time to actually do those kind of trade management, then you actually can consider a 30 to 45 days expiration, because like this tends to give a higher premium, and then usually you just have to manage the trade, to monitor the trade after each month. So that a year got 12 months, so that you just have to monitor this position for 12 months. If let's say you are doing a 30 days for each month, you know, right? So and then you also get higher premium. But the cons is what? The cons is you don't get the flexibility like what the 7 days can do. Like you only can adjust the strike price after 30 days. No, this is the cons of the 30 to 45 days, but you get higher premium. So there's always a flip side. Okay, it depends on what kind of traders are you, what kind of investor are you. If you are a more active one, you want more flexibility, then you just go for the shorter time. If you want you don't want to monitor the markets that frequently, then you just you can go for a longer expiration, because it just pay you more, you know. Okay, so far so good. So if let's say you guys can follow just step 1, okay, I want to make sure that you guys understand the expiration part. Okay, yeah, you guys been catching up already. Yeah, no. So the next one is choose your strike price. Okay, well, lots of people, okay, especially nowadays, they simply just don't do any analysis on the stock. Okay, selling a put, it seems like a holy grail to them, but if as a matter of fact, you actually have to conduct your own analysis. Okay, you actually have to conduct your own analysis. Say for example, it's like some of the people, they just selling a put without this kind of a thesis. They have no idea where they just simply look at the premium. They just sell the put because of the premium is very high during the time, without knowing that why he want to sell the price at that strike price. This is the huge problem, you know. It is a very huge problem. So in our world, in our option trading worlds, or maybe like some of the professional traders, right, they will conduct their own analysis first. Okay, the first types of is the method. It can be like valuation. Say for example, like if let's say you do your PE, or maybe you do your forward PE, or maybe a discounted cash flow, you already did all those fundamental and valuations model, and then to justify how much is the stock price worth. Like $100 shares, maybe you calculate already, you do all those analysis, you think that it will be worth $95, and then you are willing to collect the price at $90. That's where you potentially you can sell the put at your, it can become your strike price. You guys understand, right? If you guys follow, you type 1, okay, you did your analysis already. Now the stock price is $100. You think it will be worth $95, and you want to buy it at the discount, so that you think that you are comfortable to acquire the stock at $90. So you sell a put strike at $90. You guys understand what I'm saying, right? If you understand, you type 1. Okay, because like most people they don't buy at the fair value, right? They buy when it's under value, right? You don't buy at fair value, because like if you just buying at the fair value, there's no room for actually like for you to go up, right? Like yes, that's what I'm saying. So that you want to buy at $90, so that you have room to go back to $95. So that's the strike price. It can be like $92, it can be $93, but most people they just don't buy at at $95, unless you, based on your analysis, you think that the stock price can go beyond $95 after a few years. Then that's a different story. You can just sell put at the fair value prices. This is the first method for the fundamental investor. The second one is that very simple. You just look at the chart. You go swing high, higher low, higher high. Okay, and then you look at the support there, so that you think that you are comfortable to acquire the stock at that level, so that you just sell at that level, the strike price at that level. Okay, so let me look at it. I think the support level is above EMA, better to sell. But yes, but you also have to justify which prices you want to accumulate the stock at. You know, if let's say you just using the EMA is not a static things, but selling a put require a static justification. You know, if you are selling a put at like 90, then you will be holding you need to hold the position for says you enter into a 7 days expiration, then you have to hold 7 days. But when EMA can change by daily, so that be mindful of that. You still have to justify your static level where you want to buy the stock at. Okay, so the third thing is the delta. Okay, I didn't teach Greeks for this section, but basically, if you look at your apps, right, you can see some of the on top of the tabs, right, there will be one category is the delta category. So like there's lots of the option trader, basically they would just selling maybe like 0.2 or 0.3 delta, because in the theoretical mathematics world, they were just representing, if let's say I'm selling a 20 delta, basically it means that there will be only 20% of the probability it will hit the strike price, which means going in the money. Okay, which means that there will be 80% of the probability it will be out of the money. Got it? Can follow? If let's say you are selling a put that have 0.20 delta, which is 20 delta, we call it 20 delta, which is telling you that there will be 80% of the probability it won't go in the money. Okay? All right, it's kind of tough because I didn't cover the delta, but I just give you guys a pretty like a brief introduction to how some of the option trader actually use this kind of delta to actually selling a put. And then of course you still have to look at 0.20 delta is what strike price. Are you comfortable to buy at that strike price level? Okay, so be mindful of that. Don't just look at the probability at the delta and you just sell put like that. You still have to look at the strike price as well. Are you comfortable to buy the share at that strike price? So yeah, be mindful of that if you guys are using this method. Okay. The last one is just executing the trade. Basically, you just look at the option chain. You tap the buy from buy to actually switch to sell, and then call, then you just switch to put, and then select your strike price. Then you just collect your premium instantly. Okay. So the management is what? What is the management? In the cash secure pool world, because we want to accumulate the stock, right? We want to buy the stock, right? Okay, whether you are accumulating, you want to hold it for long term, or maybe you want to hold it for 1 or 2 years. So you don't need to actually close your option position. Basically, you just let it expire, and then there will be only two scenarios. Okay, I want you guys to actually recall back what I have taught during the chapter 2. Remember the auto assignment and the auto exercise. Okay, remember the thesis after expiration. If let's say your strike price is in the money, it will trigger auto assignment for the seller, or if let's say for the buyer, it will trigger the auto exercise. I want you guys to recall that the knowledge that I taught you guys during the chapter 2. Okay, so if let's say the underlying prices stay above the strike price, like if let's say you sell $95 strike price, if it stay above this level, then you just keep on collecting the premium. There's no management required. You just let it expire worthless. You don't have to close your position as well. Okay, just let it expire worthless. Another one is that it just goes below your strike price already. Then you're happy because you're finally it hits your what? It hits your ideal buying price already. So that it will automatically to do what? To help you to buy 100 shares into your portfolios. And then you get to keep the premium. Okay. And then the best part is that if you are letting the option expire worthless, right? Okay, it will just worthless because you are not closing the position, so that you don't have to pay any extra fees. You just expire worthless because you are not closing the position. You are not placing in any order. You just expire worthless, so you get to collect the premium just like that. Okay. I will be giving some of the example flow, but before that, I want you guys to actually tell me do you guys catching up the whole idea of the cash secure put? If let's say yes, type 1. Okay, before I move on to example flow. Okay. Any fees of I think I just answered your questions, right, Scorpio? Yeah, about the fees things. Only when assignment, then there might be like exercise fee, those kind of things. Commission fees won't be involved. It will be just involve assignment fees or exercise fees, if I'm not mistaken. But if let's say it's like it won't, if let's say doesn't hit your strike price, there's no fees involved. Okay. Okay. So now you guys have been catching up. So now let's look at the different scenario. Okay, different kind of a scenario. Say for example, it's like Apple is let's say the Apple is trading at $200. You have 19,000 cash. Okay, and then you're willing to buy at 190. Okay, you're willing to buy at 190. So what we doing now is like we're willing to buy at 190, and then we don't want to monitor too frequent. Okay, we don't want to monitor too frequent, so that we sell a 30 days 190 strike price for how much? During the times maybe the price is trading at $2, which is saying that we are collecting $200 in this case. Okay, we have the cash. We are happy to buy at 190, and then we are collecting $200. So what happened at the expiry? Okay, the first one is the $180. Okay, from the stock price from $200 drops to $180. So that is below the strike price, right? It's below the strike price. So even though the stock price now is trading at $180, but because you sold a put options at $90 strike price, you are obligated to buy at 190. So if let's say you are traditional buy limit, those kind of traders, okay, you just happy because you just bought at 190, but your unrealized P&L will be down 1,000. Okay, in this case down 1,000. But if let's say we are cash secure put after expiration, we also bought at 190 because even though the market is trading at 190, so we bought at 190. So our equity is what? Our stock unrealized P&L will be down 1,000 also, but because we collected the premium $200, so that our actual P&L losses will be only 800. Okay, because we collected the premium already, what? So that this is our profit, but it's trading at 190. We bought at 190, so that comparing to the stock, we only lose 800 compared to the limit order. But if let's say the stock price from $200 goes down to 189, slightly drop. Okay, but it's still below 190, right? It's still below 190, right? So For limit order, you basically you just bought it at 190 and then you are down $100. You're just down $100. But if let's say you are cash secure put, your stock will be down $100 as well. But because you collected the premium, basically in this case, you are profiting $100. Okay, you guys can follow. Tap one if you guys can follow. Can you guys tap one? If let's say you are follow. If you are no, then tap two. I can repeat again. Okay, right. Yeah, I think option hunter is keep on addressing the advanced questions. Okay, so if the strike price is trading at the monies, okay, sometimes it's like 190 point, close at 190.12, something like that. Okay, drop at that level. Basically, your order fill, your break even will be zero, but in this case, you are collecting the what? You are collecting the premium as well. At the money is the most controversial. Sometimes you also get a signed one. Sometimes you get a signed also. Okay, so that but in this case, you're also collecting your premium. But if let's say you got assigned already, most likely your stock price will be at break even, but you're also collecting the premium. Okay, but if let's say the stock price from $200 goes down to 195. Okay, if let's say I'm only placing the limit order at 190, I get nothings, right? I get nothings. So, but for the cash secure put cases, I'm collecting $200 in this case because the stock price closed at 195. It doesn't close below 190. So I get to collect $200. Okay? But if let's say the stock price rally, it just went up further to 220. My order didn't get filled also. So I get nothing. In this case, I also get 200. So the opportunity cost, I still get some things, even though like the stock price went up a lot. I missed the profit, but I still get the $200 prices because we already conduct our analysis. We're only telling ourselves saying that I'm only comfortable to buy at 190. Okay, understand? Oh, I see a lot. Some of the two like, which part you guys don't understand? Can you guys kind of let me know? Basically, it's just this part is just telling you that the stock price, as long as the stock price below the 190, you need to buy the stock. If let's say for traditional, if let's say you're placing a buy limit, right, it will trigger your buy order. You buy at 190, you buy at 190. When during that times, your stock price is likely to be losing 1,000. This one losing 100. In this cash secure put cases, because we got collecting the premium, so that it can add some sort of the buffer to our whole P&L. Okay. Okay. So yeah, so that basically is like that's what it's going to be lah. Okay. All right. So let's move on. So like let's look at how is those in a reality how you guys actually will do the cash secure put. Say it's like you want the Apple, but now it's too expensive. Here's how you actually get paid. The stock price is now 200. Same, we just selling up. Now we conduct our analysis already, so we think that 190 is the price that we're comfortable to buy at. So like we sell the put, and then we're collecting $200. At the end of the days, like after expiry already, the stock price went up. It went up to 205. So your put is what? Your put expire worthless. So your cash release, then you get to keep $200. So we got $200 profit. And then, but you don't get any shares, right? Because like it doesn't goes below what? Below 190. 190. Okay. So this time you think that okay, maybe the price went up a little bit already, 205 already. Okay lah, maybe you conduct your analysis again, you find a support, then you find the next support is that at 195. So you sell a put at 195 and you also comfortably to buy the Apple at 195. Okay, you're also comfortable to buy at 195, and you also collecting the $200. At the end of the day, it's like after the option expired, at the expiration, the Apple trading at 198, 198. But it still doesn't goes below 195, right? It doesn't goes below 195, right? So the put option expire worthless. You get to keep another $200. So in this case, 200 plus another 200, you got $400. Okay, you got $400. So you see the price now is 198 already. So you might be getting greedy already. So you see it's like, okay, maybe I want to buy at 190. Maybe I'm right. You know, maybe I'm right. Actually, like the 190 is the real support. Then you sell 190 put, and then you're collecting another $200. At the end of the day, the stock price went down to 185. So in this case, it's below the 190 strike price already, right? And then you have a 19,000 in cash in your account. So the cash will be used to buy the 100 shares of Apple at 190, even though the price now is like 185. Okay, so the total premium you'll be collecting is 600, 200, 200, 200, 600. So, but your effective buying price is at what? 184. Why? Because you buy at 190, but you also collected the premium during the times, right? So that basically your effective buying price is at 184. 190 minus 600, you're actually buying at the more discount, buying the stock at a much more discounted prices. Okay. But in your portfolio, you will be seeing like you're still buying the shares at 190. It's just that in terms of your P&L, you will be having a 600, so that in overall to see is like you're buying this the stock price at 184 theoretically. Okay. So don't just say it's like, oh, why it drops below, I collect the premium, why my stock is still doesn't long at 184. No, it doesn't work that way. You collected your premium already, so that you have to check your account. There will be extra monies in your accounts already, but your stock price is still long at 190. Okay, be mindful of that. So what's the risk? What's the risk and the rules? And then this part is more towards like those kind of a psychological level, like the FOMO risk. Okay, missing the rallies. Okay, so some people is like you sell a put, like say it's like $100, you sell a put at $95, then out of a sudden it's like the stock maybe like got some earnings, or maybe some of the news, some of the good news, or maybe some good guidance trigger up the stock, they just shoot up like 50%. Your maximum profit is how much if you are selling a put? Can anybody tell me? If let's say I'm selling a put at $2, the stock price went up to 50%. How much is my premium? Can anyone answer me? Let's do some interactions, because you're almost at the end of the sessions already. Okay. Yeah, still two. Yeah, basically still two. Your times are 100, then it's like you're collecting $200. Still two, but you miss out what? The stock price went up to 50% already. So some people's like they will feel imbalance in their psychological, But the fix is what? You just have to accept it, You already make the money, okay? If let's say the stock price get down, and then the story will be different, right? Oh, I get to collect another $200. It get out a little bit only. So that kind of a psychological also different, because like because the whole idea is just like buying the underlying at your ideal prices that you comfortably want to own it, and then you want to get paid from it. That's the whole idea. So that even though the stock price went up a lot, there's none of our business because we can't control it. You never, unless that you got some insider news, I don't know. But if let's say you already got the insider news, you won't be selling a put as well. I think you will be long a call, right? But if let's say just because you don't know, you have no idea what's coming next, but you conduct your analysis already, you do your fundamental analysis already, you think that it will slowly going up, but you're only willing to buy at that prices, so that you sell a put at that level, and you have the cash, so that even though it goes up, you just accept it, just move on. Okay, some people, like some of my friends, they just cannot get away from that trade, just one particular trade, they can talk for like years, they can talk for years about that trade. Like for me, I'll just move on, because that's the whole idea. This is the strategy I picked during that time. I think during that time, that is the most optimal choices that I think is ideal for me, so that I made this decision, so that I accept whatever it comes out, then I move on. My that friend never coming out from that things. Okay, so another things is that the downside risk, catching a falling knife. Okay, if let's say the bad news hit, okay, the companies, like say for example from 200 it drops to $100, you are wants to buy 190, you facing heavy losses. Basically, what is the fix? You have to basically you can only do your really really heavy due diligence on your analysis first before you actually selling a put. Okay, there's no other way, because like if let's say you have no idea what is the outcome, and you're betting the companies will be doing well, so that you sell a put at 190, you think it won't drop below 190 no matter how. But sometimes if let's say you don't do a very deep analysis, you just selling a put for the sake of the premiums, right? And then sometimes it can hit quite heavy, because as I mentioned already, selling a put is just like allowing you to collecting a premium and buy at your ideal prices. If your ideal prices is not really that ideal, even you yourself also couldn't believe that you will be buying at that prices, you avoid using this strategy. You never ever sell a put on a risky, highly speculative and dying companies. Okay, you just like have to like really do your own due diligence and then to decide your strike price. Okay, expiration and premium, those kind of things is very easy to solve, but to picking up the real strike price is the tough one. Okay, it can be support, it can be valuation, those kind of things. But if let's say you know that the company tomorrow will be releasing the earnings, right? Maybe you don't want to sell it because you have no idea whether it's gap up or gap down. Okay, so to be mindful of that. Okay, check everything, okay, before you sell your put. Some people like wait after the news, like for example the company is very good, and then the earnings release already, and then out of a sudden it gap down. It gap down already, then you see the fundamental is still good, it's still growing. You can sell another put at a much more lower prices, because if let's say the company fundamental is still good, you still think that the company can be grow in the future. You're happy because like you're able to sell a put at a much more lower prices and collecting the premium if it does hit your share price. But if let's say eventually it gap up, then maybe you during that time you also can conduct your own new analysis on this company, because you get the latest earnings report. Okay, you get the latest earnings report. No, this is the things the things that we need to be aware when you do a cash secure put. Don't sell put because you want the premium. Okay, you want the premium. Just don't do that. Okay, be mindful of that. You still have to you really do your own due diligence. I've seen a lot for the sake of the premium, and they're getting themselves into a trouble. they're buying the stock at the price that they initially not willing to want to buy it. Okay. And then also do not use margin. Okay, this is my really final advice. It has a name for a reason. Okay, it's cash secure put. You must have the cash in your account. Okay, you don't use the margin to actually. It's not margin secure put. Okay, it's called cash secure put. Is you must have a cash in it. Okay, don't use the margin to actually, because like if let's say you are accumulator, especially if you are accumulator, you want to hold it for long terms, then you must make sure you have a cash, because like if let's say you're using a margin, you basically paying the interest as well while you're holding the share. There's no point for that. Make sure you have the cash, 100% cash, keeping in your account. It can be like like depends on which region you are. If let's say you have a cash plus, you can be release the buying power to actually sell the put. Yeah, that's better. You must have the cash in your account. That's the things. It's not margin. No. So the whole summary is that there will be 5 rules of the smart shoppers. Okay. Only sell on the stock that you want to own. This is the golden rules. Okay. There's no way out. Okay. Only sell the sell put on the stock that you want to own. Okay. Assignment is a feature, is not a bug. Okay. You need to be happy to buy the stock. You need to be happy. Okay. Because like you are buying the stock at the discount. If it doesn't hit your strike price, then you just leave it. Okay, you just leave it. You just collecting the premium. Okay, instead of like placing a limit order, you get nothing. Okay, pick your happy prices. I mentioned just now already. I keep on repeating myself because it's really important. Okay, selecting the strike price that you fundamentally believe is a market. Don't sell the put because of a high premium and with a highly risky strike. Like some people like I even seen like sell in the money strike price, but they have no idea what is premium is. What is the option is. Okay. Keep cash secure, not over leverage, and then make sure you don't use margin. Okay, please. In like investing, it should be like like helping your life. It's not like adding the trouble to your life. Okay, don't use the margin. And margin is only be used if you know what you are doing. Okay, like you are trading a breakout and then you already have a stop loss, you know where is your max loss is, then you may consider using the margin. But if let's say you want to use the margin to actually like cover up the buying the stock things, this is not a good idea. Okay, it's not a good idea. And then you need to embrace the boring as well. Remember, this is an income strategy. You did your own due diligence already. You're just watching the put expire worthless month after month. This is exactly what you want. Actually, it's a consistency. It's a repeatable cash. Okay, you need to embrace this. I think this is a beauty. This is the beauty of the options. You're just allowing it to run until it hit your strike price, then you happily buy at the low price, at the bargain, so that you just wait it goes up. If let's say you are doing a DCA, much more better because you are buying at the discount and then even collecting the premium. If you are DCA the accumulator, and then you also can prepare for will, because remember, like will we will be covering up the next chapter. Basically, we will get the assigned already. You can actually do cover call on that stock if you're willing to actually sell the stock. Okay, you want to sell the stock away, you can do we call it the will, and it will be covered in the next chapter in a much more detailed way. You bought the stock already, you can do a cover call after. You keep on collecting the premium if let's say you eventually want to sell off the share. But if you are accumulator, you want to hold it like 10 years, like 11 years, maybe not a will. Okay, maybe you just want to keep it. Okay, keep on selling put. Okay, so I'll be just showing you at the end of the session. I'll be just showing you guys some of the backtests across 11 trading cycle in the 2025. Okay, it will be based on the real data backtest, but be mindful that historical data doesn't provide for reference only. It doesn't guarantee the future performances. But I'm just going to show you how it works. Okay, so like on January 8th, right? And then the trade was I'll open the positions during this date. And then this is the date where I close my position. Okay, which means it's expired worthless. So I saw a strike price at 133, and eventually the price drops to 129.84 that time. Okay. So that time I able to collect like $377, $377. Okay. So like, but I got assigned because like during the times the put options actually the stock price trading below my strike price, so I have to buy at 133. The second month I sell another put at 122. Okay, eventually it closed at below my strike price. I buy again at 122. But that time I collect things like 465. That time the premium is quite good actually. And then the next month I sell another put again. Okay, because I keep dollar cost averaging, like so. And then I sold a 110. Who knows that it drops like to 101. Okay, during the times. Okay, but I able to collect 412. But I also buy the stock at 110. Okay, and on the April, okay, so eventually the market is getting better and better, and then I sell another put at like 96. I thought I can collecting at a much more lower prices during that time, but who knows that it just bounced back like that. So my option expire worthless already. Then I get to collect another 332 for that time, and then May, and then I do another strike price 128 when it was like 13 somethings, and then it closed at 15 something. So like I keep on buying, I buy here, eventually at 150. I'm damn happy that time. And then but this time I didn't get to buy at like 128, so I collecting another 410. So I keep on doing this back and forth, keep on doing it. So out of the 11th cycle, I actually got assigned 4 times. Okay. So that, and then the rest of the times, I didn't get assigned. So that eventually the whole cycle, I accumulated the 400 shares during this period. Okay. But imagine that, if you're placing only limit order, these are the level that only got filled, These are the level that you didn't get filled, if you're placing the order. So you gain nothing, If you're just placing order like that, you get nothing. You just get nothing because you don't get any premium. But no matter how, I'm already prepared to buy. I just keep buying. This is I get paid by placing limit order, Okay. So this is what happened. Like if let's say if I only able to accumulate 400 shares during this period of times, then if let's say I only placing the limit order, this is the cost. Okay, this is the cost that I deploy during that time. Okay, if let's say I got hit my limit prices, this is the prices lah. But if let's say I'm using the CSP, which I did, like during this period. So same, I'll be buying those shares at the strike price as well. But because I collected this whole premium, so my whole premium profit will be 4,700 something. Okay, for 4,717. So I minus off my 4,717. So actually I'm holding this share with just like 48,783. Okay. I just kept an extra. Okay, but you guys don't have to do it like me, because like I already have the cash to prepare to collecting this stock. Okay, so like yeah, so that you can actually like do one, then you wait, then you go up already, then you sell call, you sell you sold off your share already, then you sell another put. You can do that as well. Also you can do whenever you have additional money deposit into the account, then you have sufficient cash, then you just keep on deposit, All right. So the final simple ones, like pick a company that you actually want to hold for long term, and also the target price, like beside the discount price that you happily to buy at. select the expiration, and select the strike price and sell to open. Okay. So how you actually do on the apps? Oh, it's basically we will just walk through this first, because like some of you may like just newly join. You have to make sure that you are having the same configurations as mine. You just search the ticker symbol that you want to own. For example, like Nvidia, and then you just go to here, and then you just tap on the like the setting here. Make sure you're on the list view and the shredder view, so that you can have the same feature as mine. Okay, make sure you do these configurations. So the first part, you just how do you actually sell put? So you just press on options. If let's say you already do your analysis on the ticker symbol, so you just type the ticker symbol, you tap on options, and then there's by default your option change will be just expand. Tap on this arrow, it will just collapse the whole things, and then shows you the whole expirations chain. So maybe you want to do a shorter terms, it's up to you, 15 days or 22 days, it's entirely up to you. So like in this case, just for the sake of the example, I'll be just doing like 39 days. So I'll just tap on 39 days, make sure my features is single options. Okay, make sure you are on single options. And when you tap in, it will expand the option chain. So during the times like 183, right, I think that it will goes down below to 175. I am happy to own it as well. If let's say it doesn't, then I just collect the $400 premium. So I just sell a put here. I just tap here. There will be a dialog pop up one. Okay, there will be a dialog. Remember, the put option it will be on the right side. It's not the left side. The left side is the call option. The right side is the put option. So and then you may make sure that your strike price is lower than your stop price. Okay, so I think that 775 is very good. Then I tap on it, and then there will be a dialog pop up, and then you just like have to tap on this buy button. You have to tap on this buy button. Once you tap on it already, it will turn into a sell. Okay, it will turn into a sell. It will just tell you like and then you can actually pull this up, and then also tap on, or maybe tap on this arrow. It will just shows you the whole P&L graph, and then it will shows you the max profit, break even, and the max loss. So you can see it's like the max profit I can collect is the premium that I've sold, right? It will be around like $447.50. But why is the max loss so big? Because it will assumes that if let's say the stock assigned already, the stock maximum can goes down to 0, right? And then so that I collected the premiums like 400 something, so that my effective entry price about 170 something. If let's say the stock price 170 something goes to like the stock price really go to 0, then that's my max loss lah. That's basically what it means. So don't worry about the max loss if you see some huge number, because you are prepared to buy at 175 during the time, and then you're also collecting the premium. Okay, all right. So unless you really think that the stock price can goes down to 0 lah, for very high chances lah, then you don't sell put on that ticker symbol. Okay, don't do that. So you check your everything, like as long as the stock price above 175, you get to collect the premium. Then you just press trade, and then you select the price that you want it. Like you can choose the limit price, you can choose the mid price. If let's say the spread is a bit widened, then you maybe want to consider a mid price. So once you pick up the prices already, you decide your quantity. Okay, remember one contract equivalent to 100 shares. Okay, you need to make sure that you're able to buy your 100 shares at the strike price 175, which is around 17,500. Okay, so and then you do what? You press sell. You don't press buy. You press sell. Remember, this is a cash secure put. It's a sell put strategy. Remember, you just tap on sell. Okay, before you tap sell, make sure you need to have the cash in your account. Okay, you need to make sure you have the cash in your account. You only tap sell, so it becomes what? Cash secure put. Okay, that's basically the whole sections. Okay, so maybe option hunter will be helping me address the questions. Okay, so that's basically like how the whole idea of the cash secure put. I have already told you guys like what need to be aware, what need to be avoid, and then the main things is like don't use margin. Okay, for investment, don't use margin, especially you are accumulator. Okay, Yeah, that's basically the the whole chapters, I would say. And then yeah, and then make sure that you also like follow the option playbook. And then if you guys haven't followed, please make sure that you follow. And then we have more sections to come. We already cover 4 chapter. This is the fourth chapter already. So that there will be only left with 6 chapter left. Okay, there will be 6 chapter left. Then you guys, I hope you guys by the end of the day can master all the foundation of the options strategies like vertical spread and all those kind of things. But before that, make sure you also like scan the option playbook. Make sure you subscribe it and turn on the notifications whenever we go live. You'll be able to watch me and another Elwins like to conduct this kind of a like education things for you guys, and like a strategy walkthrough platform, those kind of things. Okay, make sure that um you follow our pages. If you guys want to watch the replay, you can also visit these pages. There will be a live. You can just press the live, and then you can see the you can see the whole replay there. Okay, let me see. I can get the pages there. Okay, hold on a second. Yeah, okay. This is basically the pages. Okay, you guys go to the live here. Okay, now just now you can see the analysis from the Alvin as well. Then if let's say you guys just a beginner want to get to know about more about those how the option works. For those who just newly joined, this is a chapter 3, chapter 2, and chapter wait, okay, where's the chapter 1, chapter 2, and chapter 3. And today we just finished our chapter 4. There will be 6 chapters left. Okay. But meanwhile, make sure you also watch Alvin video. He covers some of the spread things, how you actually can, the thought process of how you actually construct a spread. It's a very good section as well. Okay. So yeah, I hope you guys actually enjoy the sections. And like it's getting late already. Okay. What is the reason buyer of put exercise early before the expiry, even the strike price is below the stock price? Hedging, because they just want to sell off their share, and then they already know something bad going to be happen. They just want to sell off their shares, but they are not sure. Maybe there's still some upside, so they just buy a put. Buying a put, basically you are betting the price will be going down, or you are doing some hedging. Okay. If let's say they don't have a stock, they just will buy. They just want to bet on the bearish direction. They will just buy a put. Okay, they will just buy a put just like that. And then but if let's say, but they will, most likely they will just close the position. But if let's say they already have the underlines there, they worry about something like earnings or anything's happen, they will just buy a put. And then if let's say really gap down, then they're able to sell their shares, exercise early their shares, even though haven't expired. They exercise early to sell their share at the strike price. But if let's say it gap up, the max loss of the buy put will be just the premium paid. But he get to enjoy the capital gains from the upsides for the stock holding. Okay. Okay. Yeah, there's always a flip side one. There's always a reason why they want to sell. Like at the beginning of the times, like when you guys see the seller max loss is like unlimited and maximum risk, those kind of the very scary terms. You guys didn't know that you can do with the cash and do with cover calls, right? You guys never know that, right? Okay. So now that you guys know why people still sell the option. And in the future, I even can teach you guys like how to actually Elwin did cover some actually. Like you want to make this kind of the monies, right? You need to have a lot of capital. Like for some people actually, like it's quite capital intense. So how do you want to make this like a lesser premium? You're able to accept a lesser premium, but it has a relatively small capital you can enter already. Then your max loss will be like few hundred or so. You can do that as well, but in the future, but that's like chapter 5 or 6, maybe. Okay. I haven't teach that. Okay, it is more of a income collecting things, but without the underlying. Okay, so I hope you guys do enjoy. If let's get you guys do enjoy the whole sections, I hope you guys can actually follow my the our community pages, and then make sure you know like follow and turn on the notifications. It's getting late. The market going to open already. I think the market is now what like going where? Market now is let's see. Let's look at the market for let's see. By the way, the desktop version is much more easy actually. Oh, the market is like the pre-market is down for a little bit, but it's like making a new high recently. But anyway, yeah. If you still have question after rewatching, can we input the question? You can. You just ask on the video if we manage to see it. But if let's say yeah, you still can ask it. You can ask on the maybe the latest latest preview. Like I still have the wheel strategy. You can like comment there maybe. Or maybe Alvin will have a preview, then you can just comment at the preview there. So we will notice it. Okay. Yeah, you also can join the Option Hunter option chat group actually if you want. Not sure whether like Option Hunter can send the link or not. Hold on a second. Let me ask Option Hunter first. Can send link? Where to join? Okay. Hold on. There will be a link to send to here. Yeah. Option Hunter just share the link already. You guys can actually check. Check the things. Possible to get a copy for your deck presented? No, this is my proprietary, my own, my things, my IP. No, cannot get the deck. Okay, but you can watch the replay lah. You can watch the replay. Sorry, yeah. I put a lot of effort into these things. Yeah, I hope you understand it. Yeah. Cool. Okay, so if you guys do enjoy, so type 1 maybe. Okay, maybe type 1. So that's how it ends. I love to ask you guys to actually type 1 like that. If you guys type 2, then both. No choice lah. You guys don't like me. Okay. So I hope you guys really do learn something from the last sections, and then like I'm sharing some experience. Like just keep you guys safe, okay? Right? Just keeping you guys trading in a much more safer way. Okay? Understand what you are doing, okay? This is very, very important. Really have to understand what you are doing, okay, with the options market. And even though the stock market, you have to understand what you are doing. Okay, it's very important. And then keep yourself safe. As long as you keep yourself safe, you can stay in the game for a very long run, and then the profit will come. Okay, I hope the profit will come along the way. Okay, all right. So, wow, long one. Okay, thank you. Thanks for you guys. Okay, but make sure you guys also follow the another Alvin ALWN his sections. He covered a lot of very good spread and those kind of things. So shout out to him. So yeah. Thank you for spending the time for attending these sessions. So as usual, our final quotes will be happy hunting, happy trading. May the profit always be with you. Okay, all right. See ya. Good night. Good night. No, good night. Also, yeah. I need to get start working already. Trading. Market open. Going to end. Yeah, market going to open already. Okay, I'm going to end my life. Okay, all right. Ciao, guys.